rotation. So yesterday we had people getting back out of their discretionary stocks, defensive stocks, going back right to tech stocks. I predicted that. I said the FOMOs and the tourist traders, they're addicted to tech. They're not going to stay in Coca-Cola very long and McDonald's. They're addicted to their NVIDIA and Microsoft and Apple. And sure enough, they started to do that yesterday. But they're losing money today. A lot of these stocks went up yesterday, going right back down because we don't have the trend. What's going on is you're getting a bad signal from Powell. Powell on December 10th and December 11th said he's going to cut rates by 25 basis points, but he's going to do a big favor to everybody. He was going to print money, the Treasury is, give it to him to go buy Treasuries. And we all thought, oh, how many? 40 billion. All right. That's QE. Let's see. What happened with QE in 2008, 10, 12, and 2020? The markets took off. Oh, so we're going to get another big rally like those. Yeah. Well, it's not happening. Because, well, here's what he's saying. He's saying, this is not QE. This is not QE. Because he said, I'm buying short-term treasuries, 1 month, 2 months, 3 months, up to a year. I'm not buying 10-year treasuries. If it was a 10-year treasury, it would be QE. He's lying. It doesn't matter. Listen, whether you buy a short-term T-bill or you buy a 10-year treasury, the effect's the same. To push down the rates, to push down the yields on both of them. The other thing, he's scared to death right now with the reserves. Banks are only as strong as your reserve. Your country is only as strong as the bank's reserves. The bank reserves used to be mandated at $45 billion. Today they're mandated at just $3 trillion. And our reserves dropped from $4 trillion to $2.5 trillion. He's scared to death of that because they could at any time, these are on the balance sheet. No, they're not fake, they're not make-believe, they're on the balance sheet. And because this debt is on the balance sheet, it can quickly go from where it's unrecognized to where it's recognized. So in other words, right now, they're enjoying this debt. It's just laying there, and they're saying, well, it's unrealized losses, it's make-believe. No, it's not. So that could happen. We could go from unrealized loss to $600 billion. That could go on the balance sheet as a loss. That's the same thing that happened to, do you remember in March 2023 with Silicon Valley Bank, First Republic Bank, and Signature? The same thing happened to them. And then they went down. Why? Because what they have to do, to meet their reserve requirement, to get it back up from 2.5 to 3 trillion, they may have to sell the 600 billion. That would be a catastrophe. Just the same thing happened with those three banks back in March 2023. So what did Powell do? He says, well, I'm going to come in and I'm going to go ahead and I'm going to start printing 40 billion a month and I'm going to start buying treasuries. But I'm not going to call it QE because if I start calling it QE, people are going to be very upset with me because the 4 QEs have screwed Main Street. Because remember, the 4 QEs starting with Obama and Bernanke was to only take care of the very, very wealthy on Wall Street, the top 10%, top 1%. And that's what happened. Each one of those 4 QEs benefited the very wealthy. Why? Because they could get money, treasuries. Okay, they buy the treasuries. The yields come down. Then Powell, or back then Bernanke, would take that money, this low yield money, and he would go to the banks, give them the money. They would go and give the money to all these companies at zero interest rates, and the companies would buy their own shares, called stock buybacks. Now, what did that do? Well, the stock buybacks, if you had a stock of $50, and if you have out there trading 1 million shares a day, buying and selling, outstanding shares, your company 1 million, and you cut it back to, let's say, 500,000, and your stock's at 50, your stock automatically, let's say, will go up to 80 without increased sales, without increased profits, without increased anything. That's why it used to be a felony to do this. So they've enjoyed this fake rally from 2008 to 2022, 4 of them. And what we found out, all it did is create tremendous inflation, where we had a rate, where the Fed had to raise their rates, short-term Fed rates, to fight the inflation, and it killed the Main Street. Just like right now, We never seen so many people on Main Street that are they can't make their car payment, they can't make their home payment, utilities are going through the roof, they can't pay their utilities. And what was their answer back in 2008, all the way up to 2020? This trick, QE, which only benefited the rich. So anytime you cut back the amount of shares that are outstanding, the first thing that moves up your earnings, but you didn't have to do anything. It's called unearned increment. And then next, the stock goes up. So Powell doesn't want to say this is another QE, because people like me say, oh, here we go again. All right, go to this big stock market rally, but everybody on Main Street, anybody doesn't make it $300,000 a year, screwed. Because your food's going to go up, your gasoline's going, everything's going to go up. So he said, well, I just won't tell them it's a QE. I'll just tell them it's short-term rates. They'll buy into this is T-bills. No, he's wrong. So remember, the next time you hear that, it's a lie. It's a QE, whether it's T-bills or 10-year treasuries. Now, look what they did. So yesterday, people were thinking, well, this has got to be QE. So they started to take and get out of, they said, we know what we'll do. I don't want to be in Lowe's anymore. So they get out of Lowe's, and they go and they start buying NVIDIA. And what happened? NVIDIA, they gave back all their profits today. They're down. It wasn't ready to sell. Look, the trend was going down when they're buying it. And that's another thing they do. Another thing they do to you. They will tell you, never, 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 right? When your stocks are coming down, you're in a downtrend, they keep telling you, buy, 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 buy. Cost average down, because they got to get their big clients out. They got to get the unions out, the pension funds out. So they keep everything at, when your stock going up, it's a buy, buy, buy. On the way down, they keep it a buy, buy, buy. You think they would change it to a sell recommendation, but they don't. Because they need you to come in and keep buying. Keep buying on dips, to keep the market up so that so the market keeps rallying, stays up there until they get their clients out. Once they get their clients out, they change the buy as the stock market's going down to a sell recommendation. What? After 2 months, a sell recommendation? Why do they do that? Because they got all this cash now. So let's say they got $500 million in cash they made in the stock market. It's sitting there. Now they're going to take that $500 million and they're going to put it back in. But before they put it back in, all those buy recommendations on the way down, just like the buy recommendations on the way up, and you helped them all get out by cost averaging down and buying on dips, guess what? You now are going to get screwed. So now they're going to take all that cash and they have a sell recommendation. Finally, after 3 months of the market going down, they finally put a sell recommendation in. They do that to scare anybody out that's still in the market, and they take the $22 billion, whatever it is, $1 million, and they put it in and they buy. Never cost average down. Never cost average down. Don't do that on a downtrend. So the question is this a QE? It doesn't matter. As long as they're buying treasuries, the first business is to bail the bank reserves out, to bail the bank repos out, okay, to help the Fed balance sheet stay strong. And the only bad news is inflation is going to come back at us. So that's it. So I hope you understand that these people who jumped in the market yesterday, not knowing what they're doing, are losing money today because the trends are still going the wrong way. And you've got to learn how to sell short. When people say, what do you think the market's going to do? It doesn't matter. It's not about the market's going to do, or what do you think it's going to crash? It has nothing to do with that. The question should be this. If the market starts to crash, do you have the skill to short? If the market's going up, do you have the skill to buy? You've got to have both. If you only have one skill to buy, and you have to buy to perfection, and the market starts going down 20, 30, 40, 50%, you just sit there and keep buying on dips? No. We can fix that for you, okay? We can. philsgang.com.